Today is Thursday, January 29th, 2026, and the market is currently open. Vale SA is trading live on the NYSE at $16.96 USD, marking a gain of 20 cents or 1.19% so far in today's session. This upward movement follows a massive surge earlier this week where we saw the stock hit a fresh 52-week high, effectively ending a long period of consolidation that had many retail investors on the sidelines. While most of the market is fixated on the price action around the $17 level, the real development that hasn't quite hit the mainstream headlines yet is the tectonic shift in iron ore production rankings. For the first time since 2018, Vale has officially surpassed Rio Tinto in annual production volume, reclaiming its crown as the world's largest iron ore producer. This isn't just a vanity metric for the board of directors, it signifies a massive operational recovery from the shadow of previous disasters and a pivot toward a high-margin product mix that the market is only just beginning to price in. Common wisdom would tell you that a mining giant like Vale is just a play on Chinese infrastructure demand. If China slows down, Vale goes down. That's the expectation. But the reality we are seeing in the data suggests a far more complex story. We aren't just looking at a bulk commodity producer anymore. We are looking at a company that is aggressively positioning itself as a core player in the energy transition. While iron ore still pays the bills, the growth narrative is shifting toward their copper and nickel segments. If you're using Fidelity or Interactive Brokers, you've likely seen the recent uptick in institutional volume for Vale stock, which suggests the big players are finally moving past the old narrative and betting on this diversification. Looking at the intraday activity, we're seeing Vale stock hold its ground despite some broader volatility in the materials sector. The trading volume has been consistently above its 3-month average, which usually indicates high-conviction buying from institutional desks. This isn't just dumb money chasing a breakout, it's a structural re-rating. When you look at Apple stock or Nvidia stock, you're looking at growth premiums. With Vale, you're looking at a value play that is suddenly showing growth characteristics. Many investors who use SoFi Invest or Robinhood for online investing have been looking for ways to hedge against tech-heavy portfolios, and Vale is increasingly filling that gap as a hard asset play with a massive dividend yield. Now, let's look at what's actually moving the needle this week. The 2025 production report that dropped a couple of days ago was a blowout. They hit 336.5 million metric tons of iron ore. More importantly, their copper output jumped to 400,000 tons, which is the 7-year high. If you are doing self-investing through a Fidelity brokerage or using SoFi Active Investing, you have to pay attention to these production cycles. When a company exceeds its own guidance while simultaneously reducing its cash costs, which Vale did, bringing iron ore costs down to about $20 per ton, it creates a massive tailwind for earnings. The tension here is between the old Vale and the new Vale. The old Vale was plagued by safety concerns and regulatory hurdles in Brazil. The new Vale, under CEO Gustavo Pimenta, is laser-focused on value over volume. Even though they are now the biggest producer again, they aren't just flooding the market, they are high-grading their portfolio. They've increased the share of premium brands like Pellet Feed China to over 60% of their mix. This allows them to capture a green premium because high-grade ore requires less energy to process into steel. This is a critical point that many online investment platforms and investing sites often miss when they just look at the ticker price. For those of you managing your own individual brokerage accounts, or perhaps using a SoFi robo-advisor, it's easy to get caught up in the daily noise, but the institutional activity here is telling a different story. We've seen firms like Capitalo Investimentos and Capital World investors significantly increase their stakes recently. They aren't looking at the next 5 minutes, they're looking at the next 5 years. They see a company with a PE ratio that is still significantly lower than its peers like BHP or Rio Tinto, despite having better production growth in the near term. I want to hear from you guys on this. Comment below how many shares of Vale you currently hold, or if you prefer sticking to the big tech names like Nvidia stock. Does a Brazilian miner have a place in your long-term portfolio, or is the geographic risk still too high for you? Let's step back and look at the actual business model for a second, because understanding the what explains the why of the stock price. Vale is essentially the backbone of the global steel industry. They operate the Carajás mine in Brazil, which is the largest iron ore mine in the world. Their logistics network, including their own railroads and ports, is one of their biggest competitive advantages. It allows them to get their product to China and Europe more efficiently than almost anyone else. In the past, the company has had a rocky road. The 2019 Brumadinho Dam failure was a catastrophic event that led to massive legal settlements and a total overhaul of their safety protocols. For years, the stock traded as a safety discount, but as of early 2026, they have completed nearly 80% of their reparations commitments and decharacterized over half of their upstream dams. The market is finally starting to remove that risk penalty from the stock price, which is why we're seeing this breakout toward the $17 range. Beyond iron ore, their Vale Base Metals division is the real wildcard. This is where they house their nickel and copper assets. They've recently partnered with Glencore in Canada to develop a massive copper project in the Sudbury Basin. Copper is the new oil for the electric vehicle and green energy transition. If you're using Fidelity mobile app or the Robinhood app to track the EV sector, you know that supply shortages are a major concern. Vale is sitting on some of the best non-Chinese assets in this space. They're aiming to double their copper output to 700,000 tons by 2030. That is a massive growth lever that isn't fully reflected in a 12 times PE ratio. However, we have to talk about the reality of the risks. Mining is a cyclical business. If the global economy enters a severe recession, demand for steel drops and iron ore prices follow. Currently, iron ore is hovering around $105 per ton, and Vale is forecasting a stable $100 per ton through 2026. This is their break-even for the industry. If prices dip below $80, the dividend, which is a major draw for people using Fidelity Wealth Management or Fidelity IRAs, could be at risk. Also, you have the political landscape in Brazil. Changes in mining royalties or environmental regulations can happen overnight and hit the bottom line hard. If you're looking at investing sites for advice, you'll see a lot of buy ratings right now. About 70% of analysts are bullish, but the expectation of a smooth ride up to $17.50 might be too optimistic. The reality is that the $17.50 level has been a heavy resistance point in the past. We need to see sustained trading volume above that level to confirm the breakout. If you're using the Interactive Brokers trading platform, keep an eye on the bid-ask spread during the opening hour. High spreads during a rally can sometimes signal a bull trap. For investors using Schwab Intelligent Portfolios or looking at Fidelity ETFs, Vale is often a top holding in Latin American and materials-focused funds. This means that as broader interest in emerging markets grows, Vale gets passive buying pressure regardless of its individual performance. This is another reason the stock has felt so resilient lately. The expectation was that emerging markets would struggle in 2026, but the reality is that investors are starving for yield and value, and Vale offers both. As we look toward the upcoming earnings report on February 12th, the market is expecting an EPS of about 63 cents on $10.8 billion in revenue. That would be a massive year-over-year jump. If they beat those numbers and raise their dividend guidance, we could see Vale stock fly past its previous highs. But if they miss, or if they signal that costs are creeping back up due to inflation in Brazil, the reality will hit the expectations hard, and we could see a quick retreat back to the $15 level. In summary, the narrative around Vale has shifted from recovery to growth and diversification. Reclaiming the top spot in production is a psychological win for the market, but the operational efficiency and the pivot toward energy transition metals are what will drive the stock in the long run. the gap between how the average investor perceives Vale as a risky old-school miner and the reality of its high-margin tech-essential portfolio is where the opportunity lies. Whether you are using SoFi, Fidelity, or Interactive Brokers, the key with a stock like this is to watch the commodity prices as closely as the ticker itself. The market has high expectations for the February earnings, but the structural changes the company has made over the last 2 years suggest they might just be able to meet them. We're moving out of a phase of uncertainty and into a phase of execution. Just remember to keep an eye on that $17.50 resistance. It's the gatekeeper for the next major leg up.